Hey there, welcome to the channel. So what a crappy week in the market it's turning out to be. My goodness. All right, so let's go ahead and look at the kind of action that we have today. um, we're just kind of looking at SPY. This is on a weekly chart. So for weekly, we're off almost 6%. For today, we are off just 3.3% on the SPY. But, it's kind of interesting, right? If we just take a minute, we had the Fed yesterday. Fed raises 75 basis points. And yesterday, it was a very muted response. Basically, comes out, we get, a chunk of volatility in here and stuff. The Fed raises by 75 basis points. And basically it's kind of interesting because that was more than expected. It was for the longest time, it was going to be a 50 basis point, right, raise. And it was like, oh, we don't expect we're going to raise by higher than that. And sure enough, within a matter of no time after the CPI came out, they go ahead and communicate this. And of course, the rumor is that, well, how did they do? Did this someone send a text over there and leak it to some, CNBC or someone like that so they could, kind of like prepare the market for it? Who knows? But it was really stable. And, it's kind of interesting because you wonder if it's kind of like, why did the market go up? I mean, I would suspect that, hey, look, it was like probably, buy the rumor, sell the news. It was probably overdone. It was like overdone. And you should always have a little relief after a Fed, right? Because look at, even if they do something that's like, oh, this is crappy, you got to understand that at least the uncertainty's over. It's like, okay, fine, they did 75. That's not great, but hey, they did it. It's done. Now let's move on. Okay, so let's look at the Qs, down. Now look at these, they're all pushing to new lows, so to kind of keep that in mind. In the Dow Jones, at new lows as well. And, kind of the Dow Jones kind of sort of lagging here. Let's look at our dollar. Dollar actually coming off the last couple of days pretty significantly. So that's kind of interesting. Don't know why that would be. And then look at this guy here, the 10-year. Very interesting. So our 10-year, today came off a lot, but it had really popped up pretty high, got up to 3.5%. My gosh. I mean, this is like really bad stuff. This is like this pop of rates. I mean, it just went in 3 days. It just went all the way to, it got to over 3.5% on the 10-year. That's huge coming off, but oh man, that's just huge. So, we're just to that point where we're just going to have to pay the piper here. Let's just look at our oil. And, oil is still working its way up here. This is a great example of technical patterns that don't really seem to do anything that you want. It's like, yeah, we had a symmetrical triangle, then it broke out, failed to break out, but then didn't break down either, and it's kind of kept working its way up the moving averages. So now trying to look out here, kind of cutting off this extreme, we're still kind of just in an uptrend now. So the oil is just, uptrending. So that's what I see at this point. We still have the cryptos are just not going well right now. We see crypto discontinuing, Bitcoin selling off more today. This is a weekly chart, so off 23% for the week. We're getting really close to being under that 20,000, and like I'm saying, hey, man, it's like you're pushing down into that 10,000. I mean, I don't know. I mean, maybe there's something here at this little thing, 18, 20,000. Not really. There's nothing there. There's no volume there. So, I mean, your support, you're going, I really wonder about Bitcoin. I really wonder if this thing is going to actually just go to zero, because it's just a mess. I mean, there's nothing there. You spent all this money to, mine these coins, and it doesn't represent anything, and this will be just like, it'll rhyme just like the tech bust. There was all this stuff like, all these companies had all these ideas, weren't making any money. They were, everything was, measured in terms of like, but we have a huge eyeballs and this and that and the other thing. And it's like, but they couldn't make any money. Pets.com, all these things went gone. But yet at the end of the carnage, stuff came out of that, right? So you had, oh, well, Pets.com went belly up, million other companies went belly up, but out of it, you got Amazon, real company, et cetera. So, is the real thing going to be Bitcoin? No, I don't think so. I think what's going to happen is that, yeah, the technology of the blockchain is going to get deployed into stuff. And there may be some companies that make some money on that, providing the software and systems to help do that, because, hey, Bitcoin, better, for documents and things like that. It's not particularly fast, so it's not really good for buying and selling stuff. And certainly the volatility is not good for that. However, it potentially seems like a good way to kind of like, hey, registering property. Think about it. Like when you go and you buy a property, you have to do a title search and you have to record the title. And basically, you don't get the keys till after the title's recorded at ESCO and all that stuff. So it might be a really good thing to kind of use that blockchain technology for things like that, So, I think that's what's going to happen. But I think all these cryptos are pretty much gone. And yeah, I mean, it's important to note that, the yields did pop out, above this previous high. So it popped out. Now, of course, it's reversed and kind of come back down. So we'll see if it sustains, but that's kind of what it's doing. And another one, I'll just take a quick look at. I looked at these short squeezes. Earnings due 729. And has 3.6 days to cover on this intercept. And what I was looking for, here's funny. I was looking at these and looking for like, hey, what companies are actually maybe basing? And this one was actually basing. If you look down here on this weekly, you see, let me zoom in here and show you. You see that you started to have this crossover, this positive crossover, but given the crashing in the market this week, given the crash, you were just starting to cross over. You have potentially a huge base, and if this could have built, but then the sell-off in the market these last couple of weeks has just destroyed that. So even though you have a company with a 3.6 day to cover, significant short interest out there, I just don't see a way to deal with it, to get to do anything with it because it's not going. And then Lemonade was another one that had a high short interest. So I was looking at that one as well because, hey, look, it's kind of coming down. The decline, I'll go over here. The decline is not, it looked like it might actually be basing, but then once again, we get some more selling in the market, the overall market. So what's happening, here's the deal. So overall what's happening is, you have a stock doing its individual things, but it's kind of getting overridden by the market over here. And that's typical, can happen a lot. And it makes it very challenging with like the technicals analysis, because you look at something, you get a setup, and it may normally be a pretty decent setup for a positive reaction. So if you had some kind of a base forming, whatever, and ready to break out, well, then it fails because of that. And so this is very common as well, that you see this kind of like, the market, overall market things will kind of hit the individual stocks and break those patterns and stuff like that. And that could be a sign of like a bear market, right? So, and it's also a sign of a bull market. So like if you were looking at, you see like in a nascent bull market or new bull market, you see stocks that like are putting in bases and they're breaking out. And you can look at these and kind of collect the statistics, and they'll collect this for you, like breakouts, like how many companies are breaking out of bases today. And you'll see that at nascent bull markets and stuff. You see massive amounts of breakout of bases and stuff like that. And companies that otherwise, wouldn't break out, they break out because the overall market is kind of helping push them up. When we're in the opposite phase now, where it's like pushing them down, the market is pushing everything down. Just to start Bitcoin to QQQ. Yeah, so the black line is our Bitcoin and purple is QQQ. So, I mean, it's pretty dang correlated. I come from an engineering view, and when you see a chart like this, these are correlated. You have these little areas where Bitcoin did better, and this area here, Bitcoin did better, but overall, they're pretty dang correlated. So the other thing I wanted to talk about was just, what's going on with this inflation, what's really happening here, and what's just not understood. I think it's almost like a moral situation. It's like, look, we've had a culture that believes our culture is like, look, we want instant gratification, want everything now. And we have a culture now that's forming up since the great financial crisis, where the government had TARP and spent all this money bailing out banks, and everyone was pissed off about that, which of course they should have been. But the issue is that that's turned and morphed into the AOC Bernie type of, hey, look, we need universal basic income, we need this, we need that, we just need to spend the money. We can just spend the money because we just print the money. And so on one hand, they're correct, right? They're like, hey, you just printed the money. But that's not correct. You can't do it without a consequence, because the issue that you have is that what's different this time, okay, is that this time this money went to real people. It didn't go to banks. It didn't go to that. And once again, this is, here I'm looking at the M2 money supply on Fred. This is the main thing. This is the reason that all the money, the M2 rapid growth in the money supply, this is why we're having this inflation. Okay. It's not due to supply chains. You can't have something for nothing. The point is that we printed all this money. We said, hey, you don't have to work. You don't have to do anything. We can print the money and we can do it. And there's no consequence. Well, that is wrong. There is a consequence. It's funny because you look at this stuff, you can look at it in physics. For every action, there is an equal and opposite reaction. These basic laws of physics. And it applies to life. And this is exactly what's happening. You sit there, we went in really quickly, had a 25% increase in money, and then we continue to pump the money. And now finally, the money supply is finally starting to drop. But you put all that money out there, you put it out there so quickly, you're going to have inflation. There's no way around it. And it's very interesting because right now, you still have people trying to blame supply chains, trying to blame oil prices, trying to blame other things. I mean, Biden administration is just a joke. They're like, well, we need Build Back Better to fix this problem. Like, no, that's not going to fix any problem. All you're doing is spending more money. You're causing more problem. You're making this M2 go up more. And the more it goes up, the simple fact of the matter is the more inflation you're going to have. And California is also doing stupid things. They're giving people $400. And is that going to help with gas prices and inflation? No, it's not. Because everyone's going to take that $400. They're not going to cut off demand. The Fed is deliberately putting the economy into recession because they have no choice. Now, if more states do things like California, and if we get in a situation where the federal government decides to come out and do something like giving people money, then the Fed's going to have to hammer down even worse. Because think about it, if this is what's happening right now, this M2 is starting to drop off, and that little drop is the pain that you're feeling in the stock market, in the bond market, that little drop. So this thing needs to drop off like a lot more. We need to get this growth rate way down. It's the only way to do it. And that's what the Fed is doing. And therefore, we really should know this. Like if you study history, we had the Roaring 20s. Even the name of the 20s was the Roaring 20s. And it was just a time of excess. It's how the stock market was going crazy and everyone was making money and partying and having a good old time for a decade. And then the stock market crashed 29. And then all this other stuff happened. And we have, the 30s. So conceptually, if you have, a decade of decadence, and it's not unlikely to be like you're going to have a decade of, having to tighten your belt, because nothing is for free. You have to let this money has to disperse in ways that they have to disperse in some way to the point where it's not causing prices to go up, and it's going to take some time. And so basically what you see is that, the market has to get killed. So a bunch of money got into the market, and that has to be, that is being handled right now. That is being wiped out as we speak. So that'll cut down on the money that's out there, because remember, the money in the stock market, although it's pooled in there, when big hedge funds and things like that, they go and they borrow money, that money goes into the market. And then even when they borrow money on margin, all that money is basically comes out of nowhere and it goes into the market, pumps the prices up. Then as people, if they take money out and they take it out at like a small rate, that money can be used like buying Lamborghinis and whatever. But when that money gets lost, it's like, whoops, you're not buying Lamborghinis anymore. So in real simple terms, the big picture that I think as a nation we're missing is that like can't have something for nothing. And as weird as that is, if you're working at McDonald's, it's very important to you and the rest of the country that you work at McDonald's. I mean, you should go get an education and some skills and training to go work somewhere better. That's what you should do. But the reality is, for now, you need to work at McDonald's, because if you're not serving up those burgers, then and you're just getting a check at home, you're just helping create this inflation nightmare. That's just how it works. It's not fair. Life isn't fair. These things aren't fair. The explosion of inflation, yeah, oil triggered it and stuff. But one of the things, let me just look at oil again, and I'm going to look at the Brent here. When did Russia invade? I think it was somewhere in here, right? Russia invaded right around here, like near, yeah, end of February, somewhere in there. But it's important to understand we were already at $90+ oil. The point is, we were already well on our way to having higher commodity and energy prices. So if you look, we put a low in here at the bottom of the cerveza thickness, and we basically been going up ever since. Now, this area here, what is this? This is the Ukraine thing, right? The Ukraine thing starts about here. Well, you had already taken oil from $25. You had more than doubled it. Actually, you tripled it to $75. So that all happened without Putin's price hike, right? So you need to understand that and keep that in mind. The reason this is happening because we printed a bunch of money and people were able to use that money to go live it up and party up. You see, they were spending more and getting more money than they were able to produce, and hence we get the high inflation. And it's really spiking right now. Legitimately, that inflation is spiking right now because of this really heavy duty spikes and that very sudden. So that's why we have really, really, really high inflation right now, and hopefully it should start to settle out as we get back into a more reasonable trend here. All right, well, that's it for this one. Talk to you later. Bye.